Smart money does not announce entries. It does not chase headlines. It does not panic buy green candles. It accumulates quietly. And right now, silver is showing signs of that exact behavior. While most retail investors are watching daily price fluctuations and waiting for a dramatic breakout, something more subtle is happening beneath the surface. There is no explosive spike, no viral narrative, no sudden media attention, just positioning. And positioning is where real moves begin. If you study market history carefully, major advances rarely start with excitement. They begin in boredom. They begin when volatility compresses, when price moves sideways, when participation feels muted. That is the phase where professionals build exposure. Look at the current futures positioning. Commercial participants, the group historically recognized for being early and strategically defensive, have reduced aggressive, bearish exposure. At the same time, speculative positioning is not extremely crowded on one side. That balance is important. Extremes usually signal exhaustion. Balance during compression often signals transition. We are not seeing panic liquidation. We are not seeing euphoric speculation. We are seeing stabilization. And stabilization, after volatility, often marks the early stages of accumulation. Now combine that with ETF behavior. Over previous months, silver ETFs experienced periods of capital outflow. That signaled caution. That signaled hesitation. But recently, those outflows have slowed. In certain sessions, we are even seeing modest inflows returning. Not dramatic, not aggressive, but steady. And steady capital flow during sideways price action suggests quiet allocation. Institutional capital does not need excitement. It needs opportunity. It seeks asymmetry. It prefers entering during compression rather than chasing expansion. Right now, silver is not acting like a market in distribution. It is acting like a market in preparation. Price structure reinforces this view. Silver has been trading within a defined range. Support has been respected multiple times. Resistance has capped advances, but without violent rejection. Volatility has contracted. Daily ranges have narrowed. This is classic compression behavior. Compression is simply a period where buyers and sellers temporarily reach equilibrium. But equilibrium in markets is never permanent. Eventually, imbalance returns. And when imbalance returns after prolonged compression, the resulting move is often faster than expected. Think of it like a spring. The longer the spring is compressed, the stronger the release tends to be. But the release only happens when pressure reaches a threshold. That threshold in silver is forming right now. Before we continue, if you follow precious metals seriously and you want structural positioning signals before they become mainstream narratives, subscribe. This channel focuses on preparation, not prediction. We track positioning, not noise. Now, let's go deeper. Open interest in the futures market has not collapsed. That matters. A market that is truly weak often shows declining participation as traders exit. Instead, participation remains present. But it is calm. Calm markets are often strategic markets. Emotional markets are late markets. Another factor to consider is sentiment. Retail enthusiasm is low. Social media mentions are minimal compared to previous spikes. Search interest is subdued. When public attention fades, price often stabilizes. Markets do not reward crowded excitement. They reward patient positioning. Now let's analyze relative behavior. Silver has not dramatically underperformed during recent macro uncertainty. It has held structural support. It has not broken down despite broader volatility in other asset classes. Assets that refuse to collapse during uncertainty often attract allocation. That is not coincidence. That is capital rotation. Quiet rotation, in addition, volatility metrics show contraction. When volatility compresses, breakout probability statistically increases. Markets move from low volatility regimes to high volatility regimes in cycles. We are clearly in a low volatility regime. The question is not whether volatility will expand. The question is, in which direction? Positioning data suggests preparation for upside rather than panic for downside. Now let's discuss accumulation behavior. Accumulation does not look like vertical green candles. It looks like repeated support tests that hold. It looks like shallow pullbacks instead of aggressive sell-offs. It looks like volume appearing near support zones rather than disappearing. Silver's recent structure shows multiple support defenses. Each defense absorbs supply. Absorption reduces available inventory. Reduced inventory increases sensitivity to demand shocks. And when demand increases in a low inventory environment, price adjusts rapidly. That is how repricing begins. Another overlooked signal is time. The longer price spends compressing near resistance without breaking down, the more pressure builds. Sellers who expected breakdown become impatient. Short positions become vulnerable. Momentum traders prepare for trigger levels. When resistance finally gives way in such environments, follow-through tends to be stronger because positioning was built before the breakout. Smart money understands this dynamic. It does not wait for confirmation to begin positioning. It positions during uncertainty. It positions during skepticism. It positions when attention is elsewhere. Right now, attention is elsewhere. Macro headlines dominate. Equity volatility dominates. Currency fluctuations dominate. Silver remains quiet, and quiet assets are often ignored assets. Ignored assets with structural support can become explosive assets once narrative shifts. Let's define the critical level. There is a clearly defined resistance zone that has capped advances during this compression phase. If silver breaks above that level with expanding volume and sustained trade above it, the shift from compression to expansion becomes highly probable, not guaranteed, but highly probable. And when expansion follows prolonged compression, speed becomes a factor. The move does not need to be gradual. It can accelerate quickly as breakout traders, algorithmic systems, and momentum funds engage simultaneously. That is the risk of waiting for confirmation. By the time confirmation is visible, price may already be significantly higher. This does not mean blind optimism.